Chapter 4, Consolidation of wholly owned subsidiaries acquired at more than book value. Before we get started and get too deep into this lecture, I want you to have this slide printed out and in front of you, because we're going to work from it to get going throughout the discussion for several of the learning objectives. So here's what we have. Parent acquired the sub for 100%. Subsidiary had capital stock of $1.65 million. The parent issued a $300,000 9% 10-year bond with a fair value of $360 and paid cash for the balance. We see here we have the book value and the fair value of each of the subsidiaries' assets and liabilities. And we can see that the book value is not the same as the fair value in some of the line items. Some more information that's going to come into play in a little bit is the following. Both the parent and the sub use the first in, first out FIFO inventory method. The building and equipment have an estimated remaining life of 5 years. And then the parent has informed us that the goodwill has been impaired by $4,000 at the end of the first year. That'll come into play in a second. The first thing we need to do is to record the initial investment from the parent. We're going to debit investment sub. We're going to credit bond payable for $300,000. Remember, from intermediate 1, bonds are recorded at the face amount. Any difference between the fair value and the face amount is going to be a discount or a premium. In this case, the fair value of the bonds was $360,000. So we're going to record a premium on bond payable of $60,000, and it said that the company paid cash for the balance. The cash is just a difference of $1.65 and $360,000. We can now start the differential process and come up with the following. How much did the company pay? Well, the bonds at their fair value, $360, $1.29. They ended up paying $1.65 million. We put that into our differential computation. We see we've got the $360, the $1.2, and again I'm following the same pattern that we've done in the other chapters. The NCI value in this instance is 0. It gives us total fair value of consideration of $1.65. If we bring into it the fair value of the net assets, we're going to get $1,014,000. You can find the fair value of the net assets on that handout that I asked you to have in front of you as we're going through these. What that leaves us with is goodwill. The excess, or the difference between the fair value of consideration and the fair value of the net assets, is going to be goodwill. In this instance, it's $636,000. We now need to see if there's any excess fair value over book value. We can see from the balance sheet that the book value of the net assets is $850,000. Compare that to the fair value of the net assets. We get a difference of $164,000. That leaves us with a total differential of $800,000. You can see that the differential can be defined as a goodwill and excess fair value over book value, or the fair value of consideration minus the book value. If we break that down, it's going to look something like this, and we see that we can identify goodwill, and we can also identify each component of the excess fair value over book value. Now, the handout that you had, you're going to have to extend these numbers over, or just write these down to get the difference. And as you can see, the difference between the inventory, $59,850, the land, building and equipment. You'll notice that the difference between building and equipment is going to be the $1,235,000 minus 507, the accumulated depreciation, as compared to the 910, which is the fair value. Again, the total differential is $800,000, and from this, we're going to have to maintain a differential schedule because we're going to have to do something with this goodwill and these excess amounts. Here's what we're going to do with our differential schedule. So go ahead and set this up. You may want to pause the video, set this up, and on the top of the schedule is going to be each of the items that had excess fair value over book value. Bonds, goodwill. Notice I put accumulated depreciation on there. There was no beginning balance, but we will use this a little later. So go ahead and include this into your schedule now. As you extend the numbers over, they should equal 800,000 as they do in this slide. So in this chapter, one of the first things we've added is the differential schedule, but we will also continue to do the book value schedule that we've been doing in the previous two chapters. We can identify each of the book value items with common stock and retained earnings, and the parent is 100% owner, so they're going to get the full $850. So as you can see at this point, we're going to come to the fair value of consideration in two components: $850,000 in the book value and $800,000 in the differential schedule.